Hi guys, welcome back to the channel. My name is Dave and I do like to trade my own options, but for many people, they like tying all this covered call nonsense up into one tiny little package in an ETF wrapper. I get it, I understand. That's why I review a lot of these products. So in the past, as far as covered call income ETFs, we've talked about things like JEPI, GPIX, SPYI. All of these are based on the S&P 500, but today I've got another one for you, and that is ISPY from ProShares. So we're going to see how this one fits in with the rest. Try to figure out which one we like the best. So if that is what you're looking for, please stick around. So when it comes to covered call ETFs, I'd like to start this conversation off with a little bit of a warning. These aren't for everyone. If you've got plenty of time until retirement, you are likely going to be better off by buying the index itself. No covered calls. That's right. Just buying SPY or VOO or some of the other ones that are offered out there on the market. These will generally give you a better overall return with time. So if you got 10 years, you might get 10% with this particular product, whereas if you start selling covered calls against that, you might reduce that a little bit. You're going to cap your upside. Maybe you get 8%, looking at it annualized over a 10-year period. That's what historical data shows us. So these will reduce that. In exchange, though, you do get less volatility. We're going to lower the beta of our portfolio. We're not going to have these big ups and downs. We're going to have, hills instead of mountains. So that's kind of the trade-off. Plus, they get distributable income. And it's not always income. That's important to understand, too. Sometimes it's actual income from option premiums that they kept and distribute. And other times it's a combination of that and some return of capital from your initial investment. So understand the product that you're getting into and make sure it's right for you. Okay, so let's take a look at ISPY from ProShares. This S&P 500 High Income ETF is the first ETF, according to ProShares, powered by a daily call option strategy. If we look at the investment objective, ProShares S&P 500 High Income ETF seeks investment results before fees and expenses that track the performance of the S&P 500 Daily Covered Call Index. So we'll take a look at that. ISPY gains exposure to the sale of daily call options using swap agreements and does not trade options. So think about equity-linked notes that JEPI uses in a similar fashion. Not exactly the same, but we're using swap agreements here. And it doesn't actually trade options itself. It uses a third party. So let's scroll down. Performance, yada, yada, yada. About the fund here. Expense ratio, 0.55%. So that's kind of the upper limit of what I would be willing to pay for any of these, and that's where a lot of these fall. When you look at SPYI, that's right around that same expense ratio. JEPI, GPIX, some of these are a little bit lower. So what are you willing to spend? It's brand new, or relatively new. Inception date is 12/18 of 23. It hasn't been around that long. Annualized distribution yield is 7.38%. We'll take a look at that in a little more detail as well. I'd expect it to be around 10% total distributions for the year, but we'll see where it goes right now. That's 7.38 based on the last one that they sent out. It does hold the whole S&P 500, all 500 stocks. And then you've got the line here, the S&P 500 Daily Covered Call Index, call only swap. And they use Goldman Sachs for these swaps. Again, we'll cover that a little bit more, just kind of getting our bearings straight here. And then the index, this is what a lot of people want to hear about, know about. So about the index, the S&P 500 Daily Covered Call Index consists of a long position in the S&P 500, total return index, and a short position and a 1 day out of the money S&P 500 index call option. The option is sold daily, and the strike of the option is chosen as a function of the S&P 500 index and SIBO VIX index levels. The index aims to reflect higher income generation and have a lower timing risk by using daily options as opposed to monthly options. So currently, the S&P 500 is at like 53.46. I think that's right. I'll put it up here right now, and you can see I'm doing this on a Saturday of all things. What an exciting Saturday. We've got a strike price of 53.80, so slightly out of the money. You can see the moneyness there with an expiration date of 8/5. We go back to work on Monday. That's the expiration date. So clearly ISPY is focusing on time when it comes to their option strategy. This is where they're putting the emphasis. They're selling daily call option. So they're investing in the S&P 500, and then they're using swaps, not options, to gain exposure to a daily short call option strategy. So they're not doing the option trades themselves, I guess is the point. Instead, they're using Goldman Sachs to gain this synthetic exposure. In some ways, it's similar to what JEPI does using equity-linked notes. But the swaps with Goldman Sachs gives the fund exposure to the S&P 500 daily covered call index, which you can find right here at S&P Global. I'll leave that link down in the description. But this only became active back on October 2nd, 2023. If we go here 1 year, 3 year, 5 year, 10 year, you can see LD here, right? That's the launch date back October 2nd, 2023. But this is the site where you can find all the info on how the out of the money strike is selected. If you go out to 10 years, it's not going to give you all that data, but it does go back to, looks like July 2022, right around there. But you can see the performance in US dollars, and this is the total return for this index. And if we check out the prospectus, we'll understand a little bit more about their call option strategy and why they chose to do daily call options. It's because ProShares advisors believe a daily covered call strategy provides greater total return potential over the long term. So we'll see if time proves that out. Now, for those that are unfamiliar with the idea of selling options, and in this case, 0DTE options, this is basically a daily bet that the index will stay under the strike price that is sold. So remember, the current bet for this Monday is 5,380 with the index sitting at 53.45 as you see in this chart. So this 5-day SPX chart for last week is looking at our daily bet for the previous 4 days. Now these arrows are not precise, they're just examples. But any arrow here that is in green would represent a sold out of the money option that would have expired since the index finished under our strike price for that day. So these are great days. The green days are great days. These 3 days, we keep the income from the sold calls. However, we do have this one bright red arrow. On this day, we lose on the options side, but offset the loss with gains in the stocks that we own within this ETF. This is what is meant by capping our upside, which it sounds so innocent, right? We make nothing past this sold strike. And after the sharp decline the following day, did we make or lose money if we just look at these 2 days right here? You know, if we just own the index, we're about break even from here to here. But by locking in the loss with the sold call, looking at this close up here, we likely lost more across these 2 days with the option strategy because we're missing this big chunk where we capped our upside. And often these dramatic up and down days, these can be costly for these types of funds. So something to be aware of when looking at covered call funds. Gosh, ProShares, maybe a 30-day option would have been a better choice this time, but more on that later. So now let's jump over to Seeking Alpha and take a look at ISPY. By the way, I am a Seeking Alpha affiliate. There are affiliate links down below if you're looking for a stock, an ETF research tool. It's the one I tend to go to whenever I'm looking at products like this. As you can see, the end of last few weeks have been terrible for ISPY or for anything linked to the S&P 500 or just about anything else in the equity universe. It's been pretty rough. So anyway, there's that expense ratio of 0.55% or 55 basis points. Shows the yield here around 6%. Again, that's TTM, so we don't have 12 months of information. It's only been out, again, since the end of last year. But you can see the performance. This is just the performance of the ETF itself. This does not take into account any of those distributions. We'll take a look at that here in a moment. It's got $225 million of assets under management so far. So if you look at the holdings, we don't have to look at this too much. We know it's the S&P 500, but this will give you a breakdown. I want to look at the dividends. If we can jump over here, we can kind of see what the dividend history looks like and how consistent they have been, or in this case, inconsistent. So we're going to see the ups and downs. Again, this is going to be one of those products that has distributable income from those option trades. When those option trades work out, like it would have worked out on Thursday to Friday, because everything went down in value, right? So it's selling out of the money calls. They would have kept all that income, and that's what they distribute to you every single month. But there are times when they won't have option income to distribute, and during those months, you should expect to see some ROC or return of capital. So make sure you understand that concept and how that affects you, especially if it's in a taxable account. There can be benefits to that. So think about return of capital. If you have any questions, again, hit me up down below and I can probably give you point you in the right direction. So to compare this to a few other products that we've talked about, I've got all these different symbols selected here. And again, this is the total return. So we're adding all those distributions back in and comparing it to some of the other products that we've talked about. So in this case, we have ISPY sitting here at 12% since inception. So that's pretty good over 225 days in a bull market like this. Considering all those distributions as well, you made 12%. Compare that to the S&P 500, and this is just a perfect example of what I'm talking about when these tend to trail the underlying. But over the short term, they can definitely outperform. It just depends on how the market's acting. But over the long term, I'd expect VOO to outperform all of these. That's my expectation. Next up is JEPI. That's another popular one, the most popular one actually, 7.83%. Then we have SPYI from Neos, doing pretty well, 9.38%. And GPIX, another relatively new product, at 11.5%. So you can see, yeah, they've all had pretty darn good performance since for 2024, basically going back to 12/20 of 23. So after 225 days, it looks like ISPY is holding up pretty darn well against some of the other covered call ETFs that we have talked about. So maybe ProShares is right. It should just be all about zero DTE options going forward. Maybe that's the one you should buy, that's it. But I'm more in the camp of, if you like this concept of these covered call ETFs and you're willing to give up some of that upside for that distributable income and that smoother ride, then you soup bowl this concept together. You put in some ISPY with its zero DTE option swaps, right? Which is different from JEPI when they're equity linked notes, selling out of the money calls, mysteriously in these equity linked notes, which do have some counterparty risk, but a little bit different option strategy. Then toss in some SPYI, which, they sell out of the money out about 6 to 8 weeks, and they roll them at about 4 weeks. They don't sell against the full value of the fund usually. So different option strategy again. And then you can put in some GPIX, which tends to sell against less than the full value of the fund with a different expiration than all of these. So different option strategies at different times will have different effects. So why not mix them all together? I think if you like this concept, these all offer some different values. And overall, I don't know, if you mix them together, you've got a few here with very low expense ratios versus some that are a little bit higher. You're probably under 50 basis points, right? It's around 40 to 50. So that's not terrible. And you got 4 different products using 4 different strategies. And of course, all of these are based on the S&P 500. We haven't even talked about all the different ones that are based on the NASDAQ 100, which could be a whole nother segment to pair up with these. So ISPY, what do you think about this new covered call ETF from ProShares? Does it say, I already own it, I'm watching it, or I'm going to ignore it because I do options myself, or options are stupid? Let me know down in the comments what you think. And if you like this type of content, please like and subscribe. And we will see you next time. Have a great night. Take care.